Hello, Big Trends traders. This is Price Healy with your Credit Spread Trader Options Alert Service product review. So get into it. Just a reminder that everything that I want to share with you here is for your information and education only today. Nothing that we're talking about here should be considered a specific recommendation or buy or sell any particular investment. Of course, you know that you are solely responsible for your own investment decisions. The Big Trends and its staff are not responsible for any trades you choose to make. Not all Big Trends products or services are appropriate for all types of traders and investors, so always keep your risk level in mind. And Big Trends doesn't provide any personalized financial, tax, or legal advice to any individual. What we do is we take our research, we send it out through real-time email alerts, and also now through real-time text alert to your smartphone. You then decide how you best want to utilize that real-time alert information. Also consult your tax advisor before you make any investment that's going to impact your unique tax situation. So when we talk about, how to make a consistent weekly income, that's the thing that's on most people's minds these days. How can they do that and do it consistently, do it steadily week after week? We'll walk you through how we do it with Credit Spread Trader, defining a support and a resistance level accordingly, and how you can cash flow during volatile times. Now, what's the vehicle we use? Of course, it's credit spreads. That's the name, Credit Spread Trader. We're using them short term, typically over a week or so, a little bit more, a little bit less, where we see the right opportunity to take advantage of the time decay curve, which we'll share with you in a moment. But basically, when you're bullish, instead of buying a call, you're now going to sell an out of the money put and buy a cheaper put to protect yourself. So that net credit into your account is something you desire to hold on to, and when you hold on to it, you don't have to pay any commissions if both sides go out at no value. You just let the options basically expire, and you pocket that full premium that you got up front. In the case of this example, the stock's at 47. You think it's going to stay at least above 45. So you don't have to get it going straight up anymore. It can go up, it can be flat, or it can go against you by about 4%, and you're still in good shape to collect the full premium here of a couple $100 in this example. And you can see that the idea here is that even if it drops, you still have some coverage down to the strike price you sold minus the premium you collect, in this case down to 43, from 47 down 8.5%, and you're still breaking even at expiration. These examples are before commissions, of course. Factor your commissions accordingly. But the bottom line is that, of course, the worst case scenario is if it drops to 40 or less, you get a crash type scenario. You're way wrong. Then you're gonna pay. You're gonna have, in this case, a give back of whatever your maximum kind of worst case risk was. At least the good thing is by buying a 40 put, you capture worst case risk at no worse than 40 if we get a crash and it goes down to 35 or 30. The basic goal is, instead of that stock having to make a dramatic move for you when you buy an option, now you just want to make sure it doesn't make a dramatic move against you, and you get paid in a lot more scenarios for greater consistency. On the other side, if it's a call credit spread, you're bearish now. Instead of buying a put, you're going to sell an out of the money call. So the stock's at 33.5, you sell a 35 call. The goal here is, of course, going a little out of the money gives you some wiggle room and gives you all time premium to capture. We buy a further out strike to protect ourselves. And again, don't want the stock to go dramatically up. So don't do this strategy on stocks that are about to report earnings, on takeover based stocks. Those are the kind of things you don't want to walk in and see a huge gap up against you in those types of scenarios. So essentially 33.5, our break even, we collected $2 on the 35-40 call credit spread is up at 37. If it goes 2 points past the strike price we sold, even if we're wrong, as you can see, about 4.5%, we're still pocketing that premium. At 40 plus is where we lose that. Why would we ever do a strategy where we could lose more than we capture on our potential income off the trade? Because you're going to do this with a lot higher win rate because of the sideways or even slightly against you scenarios that now turn you into winners. You can be wrong by a moderate amount and still get paid. I like that part of credit spreads a lot. Now you see the time decay curve. If you look at the options time value, say 4 months out, 120 days out to 0 days on the right being the expiration date. You say, well, why not just sell like the 4-month option? Well, you got to wait too long for the decay. You say, look, the 30-day decay gets you, it looks like about 2/3 of your total premium capture, but it's even more dramatic in the 7 to 10 day range. As you look in here, you see probably get a quarter of your, if we start at $4, we're probably at least at say $1 of time with about somewhere in the 7 to 10 day range left. So the thought becomes, you know what, if you can be collecting $1 every week for 16 weeks, it's the equivalent of 120 days, then you're saying you could get $16 in total premium versus just the one-time shot of $4 if you sold it out 120 days from expiration one time. So you get a lot more bang for your buck because the rate of the fall off in the final days before expiration is so dramatic here. The slope of that line it's like a waterfall, and you can benefit accordingly. Now, from the perspective of With weekly options, we're using that to basically take advantage of that decay. So that means we should have an average of an opportunity per week, or about 4 to 5 opportunities a month compared to 1 for monthly options. We use adaptive bands like we'll show you in a minute. Donchian channels is one of our favorites for finding short-term support and resistance levels on the best liquidity stocks with a real laser focus on a nice tight focus list. So the basic strategy guidelines, we're typically going to hold these 3 to 5 days with the weekly options, and we're going to do out of the money credit spreads. We used to issue them only on Wednesday, so now we can issue them on any afternoon. So we increased our flexibility to send you a real-time trade alert whenever we see the right setup. And a lot of times we'll do 1-point strike prices, and we might say collect $20 and we might risk $80, something like that. So if you do it on a typical, say, $1,000 of maximum risk that you put up, that might give you like 12 contracts, collecting $20 a contract, something like $240, risking just under 1,000. So you're in that 25% gross return. So the idea here is that you're trying to use a steady ability to write yourself an extra paycheck with this credit spread trader system. And we'll show you a couple examples here. So with Donchian channels, we're measuring recent short-term highs and lows in the 2 light blue lines. The lower light blue line is the support. And you can see in this case, this was an example where we had, this was actually Wells Fargo on a call credit spread. So we're betting the stock wasn't going to go up right in here. And you see it actually edged up against us for a couple of days. Intraday was above our 51 strike that we sold. That's the first strike shown here, but closed back below it. So we're still okay. And it came back down and it went out for its full 25% maximum profit. That's a return on the margin money you have to put up. So you can't lose more than your margin that your broker requires you to hold for the worst case scenario if the stock closes above 51.5 at the expiration. So those were half-point strikes. These days with stocks having rallied, we'll do a lot of 1-point strikes more than anything. Sometimes even a 2.5-point strike on a higher dollar name. And then we'll look at mark on the other side. If it doesn't work, and then here's a case where it didn't work, but I still think we did a nice job for our subscribers, because essentially you see here that we had a put credit spread. We're seeing all the support down here in the neighborhood of about $56. So we sell further out of the money. We sell the 55.5 strike put. We buy the down below 55 put in this case. And, so you're getting a lot more contracts here on the half-point strike, twice as many contracts at half the price. You're still getting about $250 collected in on $1,000 of risk capital. But you can see when it's not holding like we thought, all that Donchian support that should have held in here, we're closing below it on that second circle. We're saying get out the day before the expiration in this case, took a 5% loss. If we hadn't gotten out, it would have finished under 55 and we would have had a full loss on that trade. So part of the secret of success is not just letting those odds work for you, but it's also knowing the times where it's not working the way you want and getting out early as needed. That's going to happen the minority of the time, but still we'll be proactive and help you to manage accordingly. You can do this in both your typical trading accounts, but also some brokers allow you to do credit spreads in retirement accounts like IRAs. So check with your broker accordingly. We get a lot of retirees who are looking for more cash flow because they're earning next to nothing. You may be seeing that as well on your cash. So basically, here's a way to not be buying and holding the stock market, but actually just following through on a short window to be in and out of a trade. And then once we've got that cash back in our pockets after the expiration, we wait to get the next right setup. We get a lot of financial pros coming to us to maximize their return on their time, not just a return on their money. And then individual traders who are looking for unbiased market research. We have no axe to grind, no brokerage business ourselves, no investment banking business. We don't do anything subjectively. We follow everything based on the systematic approach. We never do anything just naked, selling a put or selling a call. We would always hedge it, but not delta neutral hedging, because delta neutral implies you're constantly adjusting and constantly hedging. That's too costly. We don't need to do that. So we won't make adjustments. If we need to get out, we'll just say get out. So we'll manage accordingly. And you say, okay, so what are the common questions we get? What's your maximum risk? It's the margin money you put up on any one trade. So if we say don't put more than $1,000 margin into a trade, say if it's a $10,000 account, we'd say never more than a 10% allocation on, say, on a 10K account, would be never more than $1,000. So even if you're way wrong, then the margin requirement would be the worst case scenario where it finishes away from even past your strike price you bought. Then that's going to eat up the margin you had to put up to cover the worst case loss. we expect to manage that accordingly so we can keep you typically about half of the worst case losses, sort of our final kind of pull the plug point. If you get a gap against you, it could be worse. Commission costs definitely are a factor because you're selling one option, buying another. So make sure you're not overpaying for commissions. Check with us at 1-800-BIG-TRENDS. We can get you more information. And then you don't have to have advanced expertise in options trading. We're really your eyes and ears as well as your supplemental brain to make sure we're helping you find the right kind of opportunities and also reducing the amount of time you have to spend. So if you can't be around when we send a real-time trade alert to get in on or out of a trade, there are brokers who can help you get automatically in or out. That's called auto trading. Check with us at our 800 Big Trends line. That's in the bottom left here, 800-244-8736. Or go to bigtrends.com and look at our specials on the Credit Spread Trader program. I think you'll enjoy it. And you can also email us anytime you have a question through clientcare@bigtrends.com as well. So feel free to let us know anything that's on your mind. And if you're looking for steady income opportunities, check out the Credit Spread Trader program. Keep trading well.